All right, let's jump right into this explainer. Today, we're unraveling what has to be one of the most fascinating and honestly catastrophic financial mysteries of the entire artificial intelligence boom. I want you to imagine being recognized as an absolute visionary, someone who saw exactly where the future of technology was heading, placed your bets perfectly, and built a massive fortune practically overnight. Now imagine watching that exact same fortune completely disintegrate in a matter of weeks. We're looking at the story of a brilliant mind who correctly predicted the AI revolution, yet still suffered a spectacular trading disaster. So how does an undisputed AI oracle lose control of billions of dollars? Let's find out.
Okay, let's dive into this. Just take a second to process this number, -67%. In July of 2026, the absolute hottest AI hedge fund on Wall Street dropped by an estimated 67% in just a single month. We're talking about billions of dollars literally vanishing into thin air. Banks were suddenly demanding collateral, massive positions had to be unwound at lightning speed, and the entire financial sector just watched in total shock.
And that brings us to the ultimate paradox here. You see, the mastermind behind this fund wasn't some tech skeptic betting against the industry. It was Leopold Aschenbrenner. He's a former OpenAI researcher, a Columbia University valedictorian who graduated at just 19 years old, and someone investors literally called an AI oracle. He had predicted the AI boom. He identified the bottlenecks before anyone else even saw them coming. He bought exactly the right companies. So how on earth did one of the most successful AI trades on Wall Street turn into a forced fire sale within weeks? Well, to understand the crash, we first have to understand his vision.
Chapter 1. The AI Manifesto. Long before the meltdown, Leopold had already built this reputation for moving unusually fast and seeing things others just couldn't. After leaving OpenAI, where, by the way, he worked on the super alignment team trying to figure out how humans could control machines smarter than themselves, he released a massive 165-page document in June 2024 called Situational Awareness, the Decade Ahead. The argument inside was absolutely breathtaking. He projected that AI could automate AI research by 2027, potentially producing superintelligence before the end of the decade. But buried inside this wild vision of digital intelligence was a deeply physical investment thesis. While most investors were just endlessly staring at software companies, Leopold was looking at the ground. He realized that this revolution required actual machines, physical buildings, and massive power plants. He projected annual AI investment could exceed $1 trillion, and that future training clusters might consume as much electricity as an entire U.S. state.
And this brilliantly illustrates the physical constraints he bet his entire fund on. This was the core of his strategy. He wasn't just betting that NVIDIA would sell a few more GPUs. He was betting on a total industrial mobilization. He looked at the physical bottlenecks of the AI boom, the massive data centers, the heavy electrical equipment, the literal land required, the memory chips, the natural gas to run the plants, and the power contracts needed to secure the whole shebang. His 165-page manifesto didn't even contain a list of stocks. It didn't need to. The multi-billion-dollar trade was entirely visible right there between the lines.
Which leads us to this incredible timeline. Shortly after publishing the manifesto in June 2024, Leopold launched a hedge fund, appropriately named Situational Awareness. Backed by Silicon Valley heavyweights like Stripe founders Patrick and John Collison, the fund was an immediate massive hit. In the first half of 2025, it gained 47% after fees. Then, in the first half of 2026, the fund's value absolutely exploded, gaining an unbelievable 439%. A 25-year-old with almost zero conventional portfolio management experience was suddenly responsible for tens of billions of dollars. And then came July 2026, the crash. Chapter 2. The Money Machine.
So how exactly did that rapid ascent happen in the first place? Well, the fund took Leopold's physical infrastructure vision and aggressively translated it into financial positions. If electricity was going to become scarce, he bought power companies like Bloom Energy. If data centers were the new strategic infrastructure, he bought the companies building them, like CoreWeave and Applied Digital. He even invested privately in the AI startup Anthropic. By May of 2026, the sheer scale of this operation became public, and the internet absolutely lost its mind. A filing disclosed that the fund held roughly $13.7 billion in U.S.-listed positions. Headlines screamed that Leopold was making massive bets against the entire semiconductor industry. But here's the thing. That filing was a bit of an illusion. It was really just a snapshot taken on March 31st, not a live feed of the portfolio. Over $8.5 billion of that total actually represented the underlying shares connected to put options. It didn't show his ordinary short positions, and it definitely didn't show his financing arrangements. What that filing did reveal, however, was the fund's extremely fragile structure. Situational awareness was long on AI infrastructure companies, meaning they bet those stocks would go up, while using options and short positions against other parts of the tech market to protect themselves. This is a classic strategy called hedging. But here is the catch. A hedge only protects your portfolio if the market behaves exactly as you expect it to. And in mid-2026, the vibe shifted. Investors suddenly began questioning the massive capital costs of the AI build-out. The infrastructure stocks Leopold owned began falling. Simultaneously, the software stocks he had bet against started rising. The longs lost money, the shorts lost money, the hedge completely, totally failed.
Chapter 3. The Leverage Trap.
Let's move to and see how this builds, because understanding the math here is absolutely crucial. The hidden force behind all those extraordinary early returns wasn't just smart stock picking, it was borrowed money, leverage. The fund reportedly controlled several dollars of market exposure for every single dollar of actual investor capital. To kind of demystify these massive hedge fund numbers, I want you to imagine starting the year 2026 with a simple baseline, just a crisp $100 bill. This represents the starting capital of the fund before all the madness began.
Now apply that spectacular 439% return the fund reported in the first half of 2026. While prices were rising, leverage multiplied those gains aggressively. That single $100 bill turns into an incredible $539 in just 6 months. It feels like you literally can't lose. But remember, leverage is a double-edged sword. When prices fall, it multiplies the damage just as violently. Actually, leverage does something much more dangerous than just making your losses larger. It fundamentally transfers control from the investor to the lender. When Leopold's infrastructure stocks started falling, the banks financing his leverage demanded more collateral. To get cash, the fund had to sell positions. But selling massive positions into an already falling market pushes the stock prices even lower. This triggered a completely inescapable death spiral. Falling prices caused collateral pressure, which caused forced selling, which pushed prices lower, causing even more collateral pressure. Leopold could firmly believe these companies would be worth a fortune by 2030, but you know what? His lenders were only concerned about Thursday morning. By late July, that death spiral had completely consumed the fund. They were totally out of room. Situational awareness was forced into urgent discussions to liquidate. Ultimately, Ken Griffin's investment giant Citadel had to step in and purchase a massive portion of the fund's public equities, a portfolio reportedly valued around $16 billion. It was one of the largest rushed portfolio transactions Wall Street had seen in years. The AI oracle had lost control of his own trade.
Chapter 4. The Oracle's Lesson.
Now, what's really interesting about this slide is the final math, which perfectly explains the central paradox of this entire story. How bad was the damage really? Did the fund actually go to zero like some of those sensational headlines claimed? Let's return to our $100 example. You start with 100. You gain 439%, bringing you to 539. Then the catastrophic 67% drop happens in July. If you subtract 67% from 539, you land at approximately $178. The fund lost billions of dollars. It lost 2/3 of its value in weeks, and yet, incredibly, it was still up around 80% for the year. It didn't go to zero. It retained private investments like Anthropic. But the damage to the leveraged public portfolio? That was absolute.
So the crucial point is this. Leopold wasn't necessarily exposed as a fraud here. His central argument about the AI build-out, the desperate need for data centers, electricity, and memory might still be 100% correct. The deeper failure wasn't technological forecasting. It was portfolio construction. Leopold's brilliant vision operated on a timeline stretching all the way to 2030. But his borrowed money, his leverage, that operated every single day. A long-term thesis is absolutely useless if your portfolio cannot survive the short-term journey.
And that brings us to a really profound realization about money and intelligence. As our source material brilliantly notes, the smarter an investor believes he is, the easier it becomes to interpret concentration as courage and leverage as certainty. Intelligence, inside access, and unshakable conviction cannot eliminate financial risk. Sometimes they actually increase it. Leopold Voltzalis saw the future more clearly than almost anyone else alive. He just failed to see the risk standing directly in front of him. Wall Street does not reward a prophecy just because it eventually comes true. It rewards those who remain alive long enough to collect on it. Which leaves us with this final, provocative thought to ponder. As we watch trillions of dollars continue to flow into the physical infrastructure of artificial intelligence, was Leopold Aschenbrenner's July meltdown the first major crack in the entire AI investment boom? Or was it simply a brilliant, fundamentally correct long-term thesis that was needlessly destroyed by short-term leverage? I'll let you think about that one. Thank you so much for joining me for this explainer, and keep your eyes on the data centers and power lines, because that is where the future is really being built.